So this session, we've got a prospect generator with Mirasol Resources, Nevson Resources, probably one of the biggest market cap companies you'll see at the Metal Investor Forum. So we've got the Director of Investor Relations speaking on behalf of Mirasol. We've got the CEO, Cliff Davis, speaking on behalf of Nevson Resources, and a prospect generator, Eurasian Minerals. We've got the Director of Investor Relations, Scott Close, speaking on their behalf. So first I'll give you a little bit of a talk, and hopefully I haven't seen the other presentation, so I hope I don't steal anything from there. But basically, we've had the inauguration. So this talk is really about entering the Twilight Zone. So we know that Donald Trump now is president, and he's been no longer is he president-elect. So the reality is slowly setting in. So now what we're looking at in my talk, I'll talk about basically what have we seen so far with the commodities, what did we do in 2016, how we performed, what we think is going to happen in 2017, and how we're going to align ourselves. So this just shows you what happened since Trump got elected on November 8th. So what we saw was a strength in the US dollar, but we saw the base metals going up as well. Some of them went up because the infrastructural spending quotes that he was doing about how many trillions of dollars he would invest. Not all of these would be highly utilized in that infrastructure if you're building roads and bridges, but they went up anyway. But we saw gold and silver go down. These retraced when the US dollar got a little bit too high, but especially copper and zinc have come back to their earlier levels, and also lead over here. But gold and silver have been slower to retrace right now. In terms of the fear and greed slide that CNN Money puts up, all this is trying to show is that we did have a lot of anxiety in the last part of the year, as we saw the greed trade go up, and now we're going back to the fear trade. So all we're seeing here is that what we think going forward is we'll see a lot of volatility. And in terms of what drove a lot of the interest rate, the US dollar up, was the speculation, not that we knew, the probability was 100% probably about the interest rate hike and the 25 basis points happening in December. But what people didn't know or wanted to hear was whether there'd be more hikes in 2017. And so the proposition was there might be another 2 or 3 hikes. That's what drove the US dollar up and drove gold and silver down. And so what we've seen is the reality, the difference between what's forecast and expected and what's actually happened. And so are we going to see this again? That's the question. And in terms of inflation, something like we've seen is with oil prices going up, and now we're seeing labor rates going up in the States, and wages are a big part of the inflation. The predictions right now, we're starting to see this bouncing up from this gray as a deflationary environment to an inflationary environment. So if we see interest rates globally, and even in the States, not go up by very much and not beat inflation, these real interest rates could stay negative longer. The other issue is the debt profile. And under all the administrations that have happened, and the red ones are basically Democrats, the blue ones are basically Republicans. So under every administration we've seen since about 1984, what we've seen is since 2000 an 8% annual compound growth rate in the debt profile. And that hasn't changed with anybody that got elected. And so with the new president in play, basically the estimates are that on top of the trillions of debt to service the debt and also create more debt with the current budget, what Mr. Trump's proposing might add another $5 trillion upon that. So it's not going to get better anytime soon. So this new reality is increased uncertainty, which may not be very different. But that's going to lead to a lot of volatility, which will probably be good for gold. The interest rate hikes have not met expectations historically, so that also might lead to a rebound in gold. Inflationary expectations are rising, and so if we don't see the interest rate hikes and inflation does rise, negative interest rates are more of a reality, and the U.S. debt continually increasing. And so what did we see in 2016? And what we saw in 2016 is the base metals did pretty well, and one of them that did incredibly well was zinc, and we'll show you why. But then also we were seeing that inflationary pressure coming from crude oil, natural gas going up. But we also saw copper, lead go up as well. We haven't seen that for a while. Gold at one point was up 25%, and now it ended the year at about 8 to 10% up. So again, a lot of volatility. One commodity that we tracked and we had in our we were exposed to in our portfolio was uranium, and that basically was the biggest underperformer in terms of our portfolio exposure. So that was down about 40%. So if we look at zinc, the fundamentals do look good. And so if you look at this graph, the black lines basically define the refined balance or imbalance. This suggests a big deficit and forecasting continuing deficits going forward. But what is interesting, in 2016, we also see that the concentrates, and this is what the mines are producing, are in deficit. So it's saying that the smelters are not getting enough concentrate. And so the treatment charges and the refining charges, and I used to deal with this when I was with Phelps Dodge, and I worked as the market analyst for them in copper, is that the TCRCs is basically what you deal with because you can't control the price of copper, but you can control the TCRC. Now, the TCRCs should be going down here if the concentrates are that low. I mean, are in deficit because the smelters need concentrate. But what's interesting is that in 2017, it's forecast that this imbalance is going to change. It'll still be negative, but not as negative. But we'll see continuing deficits in the refined balance. So the support for the zinc price should be good. But with respect to TCRCs, it might change. This slide is an interesting slide for me because as I worked as a copper market analyst for Phelps Dodge, one thing we used to always look at was the weeks or days of consumption with respect to stockpiles or inventory. And when I worked at Phelps Dodge, 4 weeks or 28 to 30 days, this number here, was important to watch. If it got below that and we had a disruption or something happened, then we could see a spike in the copper price. And when I worked there, we'd gotten way below 2 weeks. And our models actually predicted it, but then my boss there at the senior VP of Phelps Dodge, he didn't believe that that could actually happen. So we never modeled it and we kept it at 4 weeks. But it did happen, and when Grasberg had their slide, copper prices spiked. What's interesting to me, and I didn't realize this, but you could see the days of inventory for copper going down, 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 down like this, and that's what's supporting this. So I think this is real. So if we do see a disruption in copper, a major disruption this time, like we saw a disruption with Bingham Canyon a few years ago, but when that disruption happened, there was enough inventories that just soaked up that loss. If we have another Grasberg or another Bingham Canyon in this environment, we could see a spike in copper price. In terms of gold price, when I worked with Newmont at the time of Pierre Lassonde, one thing he always said was if you can see gold going up in multiple currencies, that's a good sign. And so what we do see is with this retracement here, it's happening in multiple currencies. These ones are outliers because of the UK pound with Brexit and Trump's wall with the Mexican peso. But otherwise, we're seeing consuming nations of gold like China and India. We're seeing major nations like US and the euro trending upwards. Uranium, we get asked this a lot. And for me, if a producer tells me that he's kind of screwed, That's good enough for me. So Cameco came out this week and basically said that the analysts' expectations exceeded what they thought that they would actually produce. And so this obviously downplayed their stock quite a bit, but this is the reality of the sector. The reality of the sector is there's too much inventory for the consumption right now. And there's a lot of inventory to go through. So if you look at the base demand here, it's not this line that's important, which is the new mines. What's really important is the secondary supply and also the stockpile that people have to get through. So the fact that we're not seeing any long-term contracts yet suggests to me that the facilities aren't worried. And until they get worried, we're not going to see that spike. And I remember when I was with Phelps Dodge back in 2004 when we were seeing $5 per pound uranium before it spiked to, I believe, 40 or 50. We actually talked to a facility because we were looking at buying, I believe it was Western Mining, and they had an Olympic dam, and we knew nothing about uranium. And so we went to the facility and said, well, what do you think is going to happen with the uranium price? And this was a producer. And he said, well, this thing's going to the moon because there's just not enough out there. But for them, that's not a big deal because in terms of their cost profile, that's not a big cost. So it could be 5, it could be 50. They'll pay, they'll want it. But since he told us that, we knew that there was going to be there was a strong underpinning. But right now, we're seeing the producers say the opposite. So if you want to play the uranium market, it's probably not a producer right now. Maybe an explorer, because in the end, we might see this turnaround, and that's what everybody's hoping for, but it might not be to 2020. And most of these explorers, you won't see them come into production till then, at least. So in summary, the zinc deficit is real. What's interesting to me is the weeks of consumption look very low for copper stocks. Gold has rebounded in multiple currencies, and the uranium surplus may take longer than some people think. So how did the equities perform given the backdrop of the commodities? And what we've seen is that the equities way outperformed the commodities 5 times. So this is a major index of equities, the GDX in the US. If gold was up 8 to 10%, this was up 50. And the GDXJ slightly more, 60 to 70. What's interesting is the XBM, which tracks the metals, base metal producers, this was up 50%. The only commodity that I showed you that was up 50% was zinc in the base metals. And also, interestingly enough, uranium. I showed you that it was down about 40%. This is down about 15. So again, the equity's outperforming the underlying commodity. So what did we do in 2016? And we've said this before to our subscribers, is that we thought the market was improving in November, December. So we were looking for assets with solid management teams, and our exit strategy to protect ourselves was an M&A. So we had to look at it from the perspective of somebody that could potentially acquire this asset. We visited over 30 projects last year. We added 20 new positions, and at the same time, we sold about 23. Currently, we got 25 positions, but what's important here is that over 90% of the positions we hold are in prospect generators and explorers. Because we're going for and continue to go for the high risk, high reward, because we continually see the issue being that there's not a lot of high quality assets out there. The majors are not exploring, and so somebody has to do it. And it's not going to be about finding a mine, changing its name, and calling it something else, and then suddenly a new mine, and drilling a hole beside an old hole. It's going to be new discoveries, and the only way to get exposure to that is through exploration. And so in terms of what we did when we closed positions, we closed about 23 positions. Luckily, a quarter of them were acquired. So they include producers early, like Claude and Lakeshore, and then later developers and advanced explorers like Kaminak and Reservoir. Some were partially acquired, like Gold Road in Australia. Again, district-scale land packages, mining-friendly jurisdictions. That was partially 50% acquired by Goldfields. And then the other thing that makes the return that I'll show you a little bit asymmetric is that we tried to cut bait as early as possible when we found a fatal flaw. We didn't always get this right. We were late on some and way too early on others with respect to uranium. And so the average return for our closed positions was about a double, 107%. It was a 700, we went from a range of 770% to a loss of 65%. But what's interesting about these statistics is both those stocks that did the best and the worst were both initially prospect generators. Reservoir was a prospect generator, and Renaissance, who gave us a 65% loss, was a prospect generator. We beat the benchmark. Each stock has a benchmark. GDXJ is what we use for the gold. XBM is what we use for the base metals. URA is what we use for the uranium. We beat the benchmark by about 70 to 75% for these stocks. The outperformers, which ended up being more than 3/4 of these stocks in our portfolio, beat the benchmark by twice, beat it by 100%. And the underperformers underperformed by about 40. This asymmetry is what we're trying to get by recognizing fatal flaws early and getting out of stocks. So looking forward. So again, our mantra continues to be from 2016 to 2017, and we see it with what the companies are telling us. We can see it in their budgets. We can see it in their placements. We can see it in their acquisitions. What they're lacking is high-quality projects. And I've said this at the last Metal Investment Forum, they're not lacking marginal assets. They've got lots of them. What they're lacking is something not only to replace reserves, and that's not a priority, because in the last Metal Investor Forum, I showed you the depletion of Newmont's reserves. They're not about that as much as getting assets that work at today's gold price and guarantee them about a 15% IRR. There's not very many projects like that. So what we're trying to do is get our exposure to the explorationists that know what they're doing, had relevant experience in these kind of jurisdictions, district scale land packages, and what we want to see is those private placements by majors thinking that they'll fund them. So again, moving to earlier stage plays. So the reward in the end is that exposure to a project that gets that discovery and gets us that M&A, which again was about 25% of our closed positions last year. To get that asymmetry, we got to discover these, uncover these fatal flaws early and cut bait. We've been good, but we haven't been perfect. The commitment comes from watching the news and being results driven. If it stops meeting your investment thesis, then it's time to either have a new investment thesis or bail. And if somebody, like I remember when we had Mariana, when we had the Turkey coup, and everything was going on. Mariana, like shot down. We were getting lots of questions, and then we put out a letter saying, you know what, this is probably the time to come in. Those guys probably at least doubled who came in around the time of the coup, because in the end, Mariana put out their PEA just this week, and that PEA at $12.50 gold gives a 150% IRR. There's not too many projects like that. So again, what we're looking for, management teams with the relevant experience, high quality assets, district scale land packages. Put those pieces together and we'd be interested. So this is Norm and the Internal Optimist. So this guy actually might be a uranium investor, I'm not sure. But basically, we remain geologists and we remain optimistic. This market will be volatile, but I think we can play it. And when we have quality and it does go down, we'll add to our position. We won't be sellers. And so I got a minute left, but we're Exploration Insights. It's Brent Cook and myself, Joe Mazumdar. That's the website. We have some free reports and letters if you want to check it out. Brent and I will be at the Vancouver Roundup and Cambridge House over the next 4 or 5 days. So with that, I can take one question. No questions? Okay, good. We will move on.